I'm like a fucking kid in a candy store right now, you know what I mean? I got $5 burning a hole in my pocket. I'm not thinking about saving money, I'm just concerned with how many pieces of candy I can buy. What is good? I'm Justin Taylor. I woke up today and said, you know what? With everything going on in the stock market over the last couple weeks and everyone rushing to buy into the market now that we've had a correction, I'm going to talk about a foolproof investing strategy that I think people should know about. And that investing strategy is dollar cost averaging, also known as DCA, because who doesn't love a good acronym? Right now you're hearing so many people say, buy, buy, buy. The market is down right now and a lot of people, including myself, are encouraging others to take this opportunity to buy into the market now more than ever. We all know that the stock market will bounce back at some point in the future, so while things may be a little scary right now, this is the opportunity to make some investments that will end up providing some very profitable gains. Right now is such a good time to be investing because we can take advantage of buying at lower prices with the expectation that our investments will increase in the long term, netting us an even greater return. And that's why I've been so excited lately. I've been doing the exact same thing over the last couple weeks, going heavy on picking up new positions and growing my portfolio. I've been doing what most of you have been doing, which is buying the dips, investing more on days when we see larger and more noticeable declines. Speaking of acronyms, my friend Dave taught me a new acronym the other day, BTFD. What does BTFD stand for? Buying the fucking dip. That's been my new favorite phrase the last couple of days. I've literally been shouting it from the rooftops. Buy the fucking dip. Buy the fucking dip. Buy the fucking dip. Buy the fucking dip. I am. But, and I've noticed this with myself, I got a little too excited a couple weeks ago when the market experienced that pretty dramatic drop. I started picking up all kinds of new stocks left and right without even questioning it. I took a big portion of my cash reserves and went all in, which may have been a bit of a mistake. See, we all know about panic selling, when people get scared and feel uncomfortable with the stock market, so they start dumping all of their assets, even if they have to take a loss on them. But I was surprised to learn about something called panic buying, which is also associated with fear, but a different kind of fear, FOMO, or the fear of missing out. Another acronym. I've always known you're not supposed to let emotions control your investing decisions, but I thought that only applied to selling, which I've learned is not only the case, it also applies to buying. I had FOMO when the market saw that 12% dip, the biggest dip we've seen in the last 10 years, and I didn't want to miss out on that opportunity to buy low, so I started buying and buying and buying. Instead of going so heavy in the beginning, what I should have done is pace the amount of money I wanted to invest. That way, if the market continues to go down as it has, I still have money on hand to buy at an even lower point. And this technique of evenly investing your money over a specific time frame rather than all at once is essentially what dollar cost averaging is. In other words, dollar cost averaging is an investment strategy in which an investor divides up the total amount of money that they want to invest across a specific time period. The frequency is usually monthly, so you could say you want to invest $100, $400, $500 or whatever a month, and following this technique, you would be sticking to investing that set amount of money on a monthly basis, no matter what. And this investing strategy is good for many reasons, all of which I'm gonna dive into, but it keeps people investing even during dips when the average investors out there will stop investing and start selling everything off. Or in my case, keeps people from getting too eager and over investing. It prevents investors from trying to time the market, and it reduces the amount of volatility you'll experience. So here's a simplistic example just to really demonstrate how dollar cost averaging works. Say I set aside $100 to invest every week, and let's look at the last 5 trading days. If I would have put that full $100 in 5 days ago, I would have missed out on these following days where prices were actually cheaper and would have allowed my money to stretch a little further. With dollar cost averaging, I would have invested that $100 over those 5 days, and each day I would hold that amount, spending nothing more and nothing less, no matter if the market falls hard or jumps up. It's all about averaging in rather than investing big lump sums all at once. And over that period, whether it be a month, a year, 10 years, you're gonna get a return that's consistent with the average trend of the market over that time. The key here is investing that set amount consistently and on a routine basis. Sometimes you'll get more shares at lower prices, and sometimes you'll get less shares at higher prices. But most importantly, you won't be timing the market. You won't be thinking about selling when things get bad or buying in heavily at the first sign of a dip. Instead, you'll just continue to invest the same amount at the same frequency regardless. And why is this so beneficial? Because we know that timing the market is a losing game. You will never win if you try to time the market. Even if you were able to 100% perfectly predict the market, which is near impossible, over an extended period of 20 to 30 years, you would only come out slightly ahead. And since no one can perfectly predict the market, you're just better off averaging out. Ultimately, dollar cost averaging keeps you from saving too much when you should be investing your money and limits you from investing too much all at once. This kind of strategy would have prevented me from going all out, but instead I said, screw it, buy the fucking dip. It's like saying YOLO, a good motto to live by until you realize the fucking consequences of making rash decisions. And maybe now I would have more funds available at the moment to continue investing if I didn't sink so much in early on. I still have the funds, but you get what I'm saying. Ultimately, dollar cost averaging takes the emotion out of investing, keeps you from getting worried or too excited or any other kind of emotion that would affect your investing decisions. DCA is a good strategy because no matter what, all of us are driven by our emotions. Fortunately, all my emotions are kept right here inside my wallet. That's what I get emotional about. I don't get emotional. This is a good strategy for those with a lower risk tolerance because separating yourself from making any emotion-driven investment decisions or attempts at trying to time the market means that your money will be more safe. There's one last benefit that I think is worth mentioning, and that is less volatility. When you invest a lump sum of money, that investment may see a drastic change in price, possibly seeing a sudden drop. So by making smaller but more frequent and routine investments, you're gonna minimize the overall volatility and have a more consistent average price per share. Does any of this make sense? Now there's a couple caveats. I don't know, I'm not French. There's a couple drawbacks to dollar cost averaging that I want to mention. Number one, it's boring. There's nothing fun about dollar cost averaging if that's your only investing strategy. With this technique, you're super hands-off with your portfolio. And with DCA, it's most often used with Roth IRAs and 401ks where people have a portion of their paycheck set up to automatically transfer every month into the same fund regardless of share prices. With DCA, it's all about automating everything. You don't want to have to do this manually every day, week, month, whatever your periods are. This strategy is geared towards investors that are wanting to be hands-off. So typically people using DCA aren't always that active in checking the performance of their stocks and being super active with their portfolios. Most likely anyone that does dollar cost averaging isn't analyzing specific companies or looking at the performance of their portfolio on a regular basis. But I think dollar cost averaging still has some solid principles that all types of investors can learn from. Primarily, that the best strategy is just investing consistently, routinely, and for the long term, like we've seen time and time again. And the second nuance to mention here is, as of now, I believe this is the case for most brokers, and it's definitely the case for E-Trade, which is what I use. You can only set up automatic investing plans for mutual funds. You can still follow a dollar cost average type of strategy when putting money into stocks, ETFs, and other types of assets by just keeping track of how much you want to spend weekly or monthly and setting a schedule for yourself on when you'll be investing. But to completely automate it with your broker, depending on who you use, there may be different restrictions on what type of assets you can set up automatic investing plans for. AIPs, more acronyms. So I guess moral of the story is don't invest too heavy at the first sign of a decline, but at the same time, don't just hold all your money and not invest. Dollar cost averaging is a nice middle ground that ensures you're spreading out your investments evenly so that you can get the best possible return. This is just one of a million million different investing strategies out there, but I think this is a good one for those that want to maximize their returns in a way that is safe and super hands-off once you get it set up. To actually put this dollar cost averaging strategy into play, start with determining how much you want to invest and at what frequency, and then simply stick with it and watch your money continue to grow. All right, do me a favor if you made it this far, hit the subscribe button, like, comment, share, whatever else. I'll see you next time. Peace.